As we enter year-end, the financial press is focusing investors on the prospect of a U.S.-China trade accord as a key driver to markets. While important, investors should not lose sight of the fact that 1. Financial conditions around the world are tightening, and 2. Earnings expectations for companies in 2019 are too high. On the financial conditions front, financial conditions have been tight in both Europe and Asia for much of the year. However, beginning in October, U.S. financial conditions tightened very dramatically, driven by the Federal Reserve Chair. This leaves conditions tight in the U.S., Europe, and Asia at the same time for the first time since 2016. Fortunately for investors in 2016, a pause by the Federal Reserve in its rate hiking cycle and easing by the ECB put an end to the correction in January and February of that year. As we look into 2019, however, the Federal Reserve looks to raise rates and the ECB looks to withdraw its quantitative easing, leaving risk in the markets for investors as we enter the new year. On the earnings front, risk exists as well. Earnings expectations are about for 10% growth in 2019. We believe this is too high, in particular in Europe, and to a lesser extent in the US, Japan, and Asia. Downgrades going into earnings season that begins in late January should prove a headwind for markets as well. As a result, we continue to think that our capital protected exposure in portfolios, as well as a pivot towards hedge fund and other alternative exposures, remains warranted. For more details on this and other ideas, please visit us on ubp.com.